I'd like to thank everybody for joining me today. Today, I want to talk about an important topic, and that's repositioning assets, for a better result. It's as I look at this and as I work with various clients, I always see that they have assets that could be doing better. Now, sometimes these assets are what I call legacy assets. They're family assets that aren't going to be replaced. I was just involved with a client. They have a $10 million asset. It's a business. It's a family business. It's been operating for about 90 years. And I looked at it and it's returning about $100,000 a year in income. Now, are they going to replace that asset, reposition that asset? Most likely not, because they view that as a family legacy. But a lot of times we're looking at assets that could be replaced and most likely should be replaced. But to do this, I always like to look at things in buckets. And if you think about this, we're going to have buckets that we're going to fill during our working years. Most of these assets are going to be taxable, and it's money coming in. It's used to pay the bills that we have going along. Then we look at putting money away for retirement. And we all need to be planning for the future and making sure that we have enough in our retirement bucket to take care of us based on the lifestyle that we're choosing to live in retirement, where we want to retire. All of that comes in. But there's also this other bucket. What if? What if I need that money now? What if I need that money later for retirement? What if I don't need it and I want to pass it on to future heirs? And as you're filling all of these buckets, the one thing that we have to keep in the back of our mind is, what are the taxes going to do to us as we fill those buckets? Again, as you look at most of our working year bucket, those are taxes that we're going to be paying today as we grow, as we build the business, as we take W-2 income. That's taxable now, either ordinary income or capital gains. We're always going to try and minimize that. But if you look at our, especially as we look at the two different options, we've got taxable, pay as you go. Think again, the working years, that income that we need today. Yes, we'd like to minimize that as much as possible, but we need the money now. And so that drives, a lot of the decision is not so much taxes as it is liquidity, operating budgets, expenses, those things. When we're filling the retirement bucket, that's, I look at a lot of qualified plans, and I think qualified plans are a great strategy, especially to build for the retirement years. But I don't think a lot of people recognize what the big tax issue is. Yes, I get a tax deduction now, but you're going to pay for that in retirement. I've talked to a client, it's been a couple of years ago, and they asked me to take a look at their whole, financial picture, more from a tax standpoint and a planning standpoint. And as I looked at their situation, what was interesting is, with all of their deductions, from the business deductions and write-offs to their personal write-offs on their home, deductions for their kids being at home, their effective tax rate was under 20%. Now, looking at where they're going to be in retirement, they will most likely be in a max tax bracket as they approach retirement. And as I looked at, explained to them, you're taking a very, very low deduction now, especially on your marginal rate, that is going to be considerably higher, 2 to 3, maybe 4 times higher when they finally get to retirement, of what that tax bill will be in retirement. So as you start looking at this, and most people think there's only 2 options on the track: taxable now, defer it and pay the tax later. But I like that third track. That third track is tax-free. Tax-free so that you will never, ever pay taxes going forward. Now, there's not a lot of tax-free buckets. We have Roth IRAs, municipal bonds, and life insurance. Those are really our 3 buckets that we can look at as tax-free that puts us on a track that as that money grows, as we access that money, we can do it in a tax-free nature. So one thing I want to look at now is it worth repositioning your assets? Now, if you have underperforming assets, if you have underperforming accounts, can that be changed to the tax-free track that we want to be on? So I'm going to look at one, and it's repositioning to life insurance. And we've discussed life insurance on some other presentations. Life insurance has a very unique feature that most people don't understand. And that is you can put money in after tax, grow it tax deferred, and access it tax free. A lot of times when I explain that to CPAs, they're saying, well, that sounds like a Roth account, and they're right. It's a Roth account without the limitations, without those limitations of, are we limited in how much we can put in? And we can design a life insurance policy if we want to take hundreds of thousands of dollars of premium in, and that's substantially more than we could ever do in a Roth account. So is it right? So if we look at repositioning the life insurance and repositioning those underperforming assets, look at those assets, CDs, savings accounts, investment accounts, whatever those assets are. Now we can look at and say, let's figure out the best way to reposition those. Now, typically when we're funding a life insurance policy, we want to do it over time, a 5-year period, 10-year period, whatever makes the most sense in the design. So sometimes we can, take those assets and pay them direct to the insurance policy. Sometimes we want to put them into a single premium immediate annuity so that we can move the money at one time and slowly move that into the life insurance policy. But if you think about, let's pay that over 5 years. And we want to pay that over 5 years, 10 years, whatever it is, so that we make sure the access to that cash value is tax-free and we avoid some of the IRS issues. Now, let's take a step back. How are we going to design this policy? Typically, we want the lowest death benefit, lowest cost, so we can get that cash value growth if we're focused on that what if bucket. What if I want to access the money now? And what's nice is when you go to access that money, if we've designed the life insurance policy properly, you're going to have tax-free access to whatever you want to use that money for. Nobody's sitting there saying you have to use it for retirement. Nobody's saying you have to use it for long-term care. You can use it for retirement, for long-term care, take a trip around the world, buy the kids or grandkids, things that make you feel good. Whatever you're doing can be done in a tax-free nature. Now, let's look at the flip side of this what if. What if you don't need the money? If you think about a qualified plan, you put money into a traditional IRA or you put money into a 401k, and you get to those retirement years and say, I don't need the money. I don't want to pay more in taxes. Well, we know there's required minimum distributions that at some point will kick in. And the IRS and Uncle Sam is telling you, yes, you're taking that money, and yes, you're paying the taxes. With the life insurance, if you want it, use it. If you need it, use it. If you don't want it or need it, then go ahead and let that go through as a death benefit. And that death benefit will go out to your heirs however you want. Now, it can go to family members, children, grandchildren, friends, can go to a charity. Wherever you want that death benefit to go, it's up to you. And it's the money you didn't need to use during your life. The nice thing is, if it's all designed, we've got, the tax code telling us tax-free growth, tax-free access to your policy, and tax-free distribution to your heirs. So it can be a great way to reposition assets that are underperforming, underutilized, and put it into something that'll be a better fit for you now and into the future. So I appreciate you getting on today. If you ever have questions on this, feel free to reach out and we can talk about it more. Thank you, and we'll talk again next week.